Good afternoon, everybody, and welcome to Churchill Tax Advisors Tax Investigations monthly webinar. Thank you for joining us. It's great to see so many people watching these webinars each month, and also the recording of this webinar will be sent to everybody who registered. So if you haven't had time to watch this one or future ones, you will get a copy of the recording which you can watch at your leisure. Today, Phil, my colleague here, and myself, Dave Jennings, are going to talk about revenue's nudge letters and the various campaigns and disclosure opportunities that you can use. There will be a Q&A session at the end, so we'll be happy to take your questions. Please type them in the comment box on the bottom right of your screen there. We will see those questions and we will try and answer and get through as many as possible. Right, without further ado, I shall find the slides and share those with everybody. Can you see that, Phil?
I can.
Good, thank you very much. Many of you will already know Churchill Tax Advisors are a specialist advisory firm based in London and Essex, and we cover the UK. We have various offices around the UK as well, and we provide specialist tax services to accountants and clients directly. So today's nudge nudge wink wink is the title heading, and what do you do if you are nudged by HMRC, or if your clients have been nudged by HMRC? We're going to cover the Let Property campaign, the Worldwide Disclosure Facility, the digital disclosure, which is a catch-all for a campaign or a sector or a disclosure that isn't part of an existing facility. We're also going to talk about voluntary VAT disclosures, and in the worst case scenario, if somebody has committed fraud, just a quick reminder about Code of Practice 9 is also available for voluntary disclosures, as well as if the revenue issue a prompted investigation. We have covered Code of Practice 9 in detail at previous webinars. Catch up on our recording of one we did a couple of months ago, so we won't go into detail of that one. Some background then. What is a nudge letter? Well, the revenue started doing these nudge letters many years ago. I'm an ex, for those who don't know me, I'm an ex-HMRC Inspector of Taxes. I did spend nearly 19 years in Revenue and Customs. I left in 2006 to join Grant Thornton, and the last 14 years I've been working in the private practice with various accountants around the UK. I've been in with Churchill's most of 2020. So when I was in the revenue, there was a sort of campaign to start changing people's behaviours and people's hearts and minds, that tax was obviously a good thing. It paid for society, it paid for schools and hospitals and the like. So it was a start of almost like a political campaign to make people feel guilty if they hadn't paid tax. And that even happens now and still happens with regard to some tax planning, tax avoidance. Tax avoidance is not illegal. Tax avoidance is making use of existing legislation to ensure that you're claiming and obtaining the correct amount of tax deductions that you can have. Some tax avoidance has gradually maybe gone very aggressively, and the revenue over time have muddied the waters between avoidance and evasion. Tax evasion is illegal. Tax fraud, obviously that shouldn't be done, and people can be prosecuted. So all this over the time, and certainly the last decade, tax has been very prominent in the newspapers. The revenue ran various campaigns to get tax in the headlines. You may recall things like footballers, celebrities getting involved in avoidance schemes. Again, perfectly legal. Doesn't mean to say the revenue like them, and they've challenged them through the courts. Legislation over the years has also caught up with avoidance. There's disclosures of tax avoidance, the promoters of tax avoidance, the general anti-avoidance rule. There's lots and lots of legislation that has come about over the last few years. The loan charge, for instance, disguised remuneration. And the nudge letters play a part in that overall politics, if for want of a better phrase, and it's all to do with changing people's behaviour. Since self-assessment came in, which has been around with over 20 years now, the reliance is on people to self-assess their tax returns, their tax income. The revenue have also improved their IT and their databases, the information they hold, and we've covered Connect at a previous webinar, which is a massive database that the revenue hold of third-party information, things like bank account information, bank interest. They've got access to land registry, council tax, when they issue information notices to large providers of information, large databases such as letting agents, for instance. They would have all the information about their clients. They get stamp duty returns. All of this goes together with Connect. And in the last few years, as we'll cover shortly on the Worldwide Disclosure Facility, the revenue have been receiving a lot of international financial information as well. Countries around the world signed up to share that information. So all of this information goes into this huge database. So what do they then do with this? Well, they don't have the resources to open an investigation on every single case. So some 10 years or so ago, the revenue started to work with a consultancy in behavioral science, and they experimented and tried to see if they sent letters out to taxpayers. Some of them initially was just to remind people that your self-assessment due date is coming up, your payment on account date in July is coming up. A lot of these were maybe initially friendly reminders of tax that was due and payable. They gradually moved that on to specific campaigns. We've had over the years campaigns in the medical profession, the campaigns for offshore bank accounts, the Switzerland disclosures, all of these, and over time the revenue have moved on and used specific campaigns for these nudge letters, and it's all to encourage compliance and largely maybe as a cost-cutting process because the revenue can't investigate all this information they've got. So instead of raising an investigation, they will issue a prompting letter saying, please check your tax returns. We think you may have missed something off. We think you may need to make a further disclosure. So we're going to cover some of those sectors and areas where the revenue have been nudging. One of the major ones, and this has again been going some many years, is the Let Property campaign. As I mentioned with the Connect, the revenue HMRC has a lot of information from various sources: stamp duty tax returns, land registry information about property, council tax information, and they also in more recent years have information about deposits from deposit registration, etc. So they will use all that and check against that information. Has this taxpayer been declaring that income from property or that property sale on their tax returns? So they issue a letter saying that we think we have information that suggests you've owned a property, we have information that suggests you may have sold a property, and you may not have declared all of that income. The current Let Property campaign letters, nudge letters that are going out, relate to property sales in 2018-19. It's been made public on some of the sites, some of the news sites, that the revenue have issued nearly 14,000 letters recently and still ongoing with regard to property sales. Obviously, if you receive or your client receives one of these letters, that would count as a potential prompted disclosure should a disclosure be required to catch up and regularize the past. So penalties will be set accordingly. We would always say, and this is a point of this webinar really, and a reminder, that if you have clients or if you as an individual have any undeclared rental income or undeclared capital gains from sales of properties, please come forward, take professional advice. If you volunteer the information to HMRC. If you make an unprompted disclosure to HMRC, the penalties are massively reduced, potentially even zero, depending on the circumstances. If it's offshore, then the penalties are a bit higher. We've covered that on previous webinars around the WDF, and we'll cover that very, very shortly. The letter is very similar to the WDF letter. There will be a certificate to complete and fill out. Now, there is no legal requirement to complete the certificate. There is no legal binding around the letter itself. It's a voluntary letter that the revenue send out, but inevitably failure to return such a letter or failing to respond to the letter will result in HMRC opening an investigation. So before completing the certificate, before replying to the revenue, do take advice about what to do. Very similar, the worldwide disclosure facility, again, it's been going for many years. The revenue have lots and lots of information from various countries overseas. In the last couple of months, we've seen the revenue issue these letters to people with income in India, Hong Kong, in Europe, Germany, France, Singapore, and America. Again, as mentioned, if you or your client receives one of these letters, it will be treated as a prompted disclosure when you make a return and disclosure of the information. So again, check on your income, check on the past, see if there's anything you've forgotten about, or if you've been putting your head in the sand. Now's the time to come forward before getting one of these nudge letters to reduce the penalty. Now, again, we've seen tens of thousands of these letters being issued around the country. They are going out in various tranches as the revenue work through this information. As I mentioned at the beginning of this webinar, the UK, along with around about 100 odd countries around the world, have all agreed and signed up to share financial information under the Common Reporting Standard. So since 2018, the revenue have been receiving data from overseas, which is usually bank information, investment information as well, various funds that people have invested in overseas. We've seen cases where there's been maybe past share investment schemes in the USA that have been put into various wrappers. HMRC have got the information from the American tax revenue service, and again with India, we've seen information about bank accounts and bank interest. It is just a snapshot of data. It will not be the whole picture. Sometimes equally, you need to be mindful that the revenue do get it wrong. They may have the incorrect name on an account, especially with families with similar names, and it can be the wrong person they've sent the letter to. So do check and take advice on, well, what action should I do to deal with this letter? But the most important thing is don't ignore the letter. Take advice. Do you need to make a disclosure? Do you need to make a report to the revenue and say, actually, no tax is due because of X, Y, Z? Were you not resident at that time? Were you non-domiciled still? Is the amounts below exemption limits? Are there any reliefs that can be claimed? It might not be necessary to actually make a disclosure. If you do need to make a disclosure, then the registration facilities are there for both property and overseas income. You make an intention to disclose, you register your intention to disclose, you get a registration number, and then you have 90 days to disclose all the information. You have to calculate it all yourself. It's self-assessment. You have to work out your penalties, work out your interest, work out what your expenses and claims might be. It can get quite complex, and obviously the revenue can investigate if it's an incorrect disclosure. If you've disclosed incorrect years or not sufficient years, don't forget the number of years are 6 years if it's been careless, 12 years for some income if it's overseas under the requirement to correct rules and legislation, 20 years if it's been deliberate or fraud. So do bear that in mind when considering if it's an inadequate disclosure or not. An inadequate disclosure could result in prosecution. And my colleague Phil is going to mention about Code of Practice 9 and potentials for prosecution. If the income doesn't fall under one of those campaigns, and they are the only two campaigns that have a disclosure facility at the moment. There are there's a more technical disclosure around transfer pricing and foreign income, where you've got groups, etc. But we're not covering that today. That's another facility. If you do have clients where transfer pricing is maybe an issue, or there's equalisation with UK and foreign earnings, then again, seek advice, come to us. We deal with these settlements and disclosures all the time. But the other sort of open generalist disclosure facility is known as the digital disclosure. Again, it's a useful way of making a disclosure rather than something disappearing into the black hole of HMRC if you write a letter. Similar to the other disclosures, you register your intent and you've got 90 days to actually make the disclosure. It can be income tax, corporation tax, CGT, national insurance, pay as you earn, don't forget, comes under income tax. But it's important here, it does not include VAT. You can't use this disclosure or the other disclosures for VAT. That is a separate item, and it's because it's covered by different legislation. It's a different department. All right, the Customs and Excise merged with the Inland Revenue in 2006, but they still treat VAT and direct taxes differently. But again, if you need advice for making a disclosure that's not covered by the Let Property campaign or the Worldwide Disclosure Facility, do use this and do come to us for specialist advice. I'll pass you over now to my colleague Phil, who will talk you through the other option, if it is VAT, and also to cover briefly the Code of Practice 9 facility. Thank you, Phil.
Good afternoon, everybody. Voluntary VAT disclosures are something that HMRC are very keen on because it does make their life a lot easier in terms of compliance. But what I think is important is that people understand that it is an opportunity for you to identify errors or mistakes that have occurred in VAT returns, and that gives you the opportunity to be in control of making those errors known to HMRC. First of all, if you discover an error that's no greater than £10,000 or is less than 1% of the box 6 total sales figure, then you can actually make that error. You can disclose that error or put that error and pay that error on the VAT return for the period in which you've discovered the error. Makes it perfectly straightforward. You should annotate the error in such a way that it's clear on the return or your working papers that the adjustment has been made. And that would also apply if HMRC, you had not reclaimed input tax that you were due to. So the errors go both ways. You would possibly, if you were a regular payer of VAT, and suddenly you got you adjusted for an error, say by about just on £10,000, which actually made you a repayment trader, that may raise a concern, and HMRC may contact you to find out how that's happened. If, however, the errors are greater than that, then you can't make the adjust for the error on a current return, and you have to make a voluntary VAT disclosure, and that's done on a form VAT 652. Now, one thing I would say that, and follow up from what Dave was saying earlier, is that Connect is used by the whole department, and it may be that something has happened or that you've done something and they can see that they should have had more VAT paid by you than they have done. If they then have to contact you, that then becomes a prompted contact, and from there bad things will happen and flow, with the penalties being higher than you would normally have to pay. You may have to explain why you've not disclosed, etc. So if you discover an error that's large, that is something that's happened, and it could have been completely inadvertent. It could have been somebody not understanding that something had to be disclosed or put onto a VAT return. It could be something that's just been missed, a one-off invoice that may have had quite a lot of VAT on it, but just for the reasons, and especially with what's happening at the moment with people's lives being turned upside down, errors get made and mistakes are made. In that case, you then fill out the voluntary VAT disclosure. One of the key things to remember is in that the form does provide space for this, is that a full reason for the error is provided, and that you do fill out the form and fill out the reasons why the error occurred. And the more it looks like carelessness or a simple mistake, and the fact that you're making the disclosure unprompted, this will impact on the scale of the penalty that HMRC may choose to levy. And as Dave said before, with an unprompted disclosure like a voluntary VAT disclosure, it may be HMRC decide that no penalty is due, or they may decide to suspend any penalty pending mistakes not happening again in the future for a prescribed period of time. Voluntary VAT, excuse me, voluntary VAT disclosures may be a little painful in terms of having to pay the VAT that you owe, but they are possibly in the end a lot less painful if there is no provision or requirement to pay a large penalty. Any questions about voluntary VAT disclosures, please either ask them at the end of this webinar, or contact us separate of the webinar, and we'll be more than happy to discuss any of those issues with you. Next slide when you're ready, Dave. Thank you. Okay, Code of Practice 9. Everybody, well, not everybody, but a lot of people will know that the Code of Practice 9 is when HMRC contact you and invite you to take part in the contractual disclosure facility, in which you admit that you have done wrong and that you make a clean breast of all of your business activities and any fraud that may have been committed. Of course, that is then protects you from criminal prosecution, and the more cooperation you give, there is no risk of you being named and shamed. Well, the facility also exists for people to voluntarily enter the scheme without the prompting of a letter from HMRC. Now, it may be that you've been involved in fraud or deliberately not paying tax for a period of time, and it may be that you have become so stressed by the knowledge that you've done this and the fact that you want to just make a clean breast of things. And also it comes to, you just think, I just need to regularize my tax affairs. I just want to live every day without waiting for an envelope to drop through the door. And in those situations, an approach can be made to HMRC that you would like to enter into a voluntary COP9 process and sign the contractual disclosure facility, in which you will be signing up to making a full disclosure. Under those circumstances, again, you should approach us. We can then take your details, follow your instructions, and then make a voluntary attempt to register for the Code of Practice 9. These issues take a little bit of time because HMRC, of course, will do some checking against what we're coming forward with. But if you do that unprompted, it will have obviously three effects. One, if it's accepted, you will get automatically they will be accepting that there will be no criminal prosecution. You'll be protecting yourself from being named and shamed. And when the process is complete and the final report is written, you will also be being put into a position where you might be better able to get less penalties applied to your behaviour, because you will be given credit for the fact that you have come forward unprompted. Big decisions to make. In many cases, they may be huge decisions to make, but it is something that should be considered if you've not been declaring the right amount of tax deliberately, that you know you haven't, and you just want to get everything back onto an even keel. And in that case, like the voluntary disclosures and the other matters that Dave was talking about, please contact us and we will do our very best to help you. Thank you.
Thank you, Phil. So to summarise, the revenue have been issuing thousands of nudge letters for property income, capital gains, rental, and overseas information that's maybe allegedly not previously disclosed, in many cases hasn't been disclosed. Please make use of those facilities that the revenue point you towards. It can make things at least more direct in dealings with HMRC, not necessarily simpler, but at least it gets you a contact point and there's a process to use. As we've mentioned, better to come forward sooner rather than later, because you reduce the penalties massively, and that's obviously important on a financial side of things, but also what's more important is not to do things wrong, not to take the wrong step, not to create a risk with HMRC, not to end up with a poor disclosure or an inadequate, incomplete disclosure, or to be making any mistakes which can prove serious for yourself or your clients. So do take specialist tax advice. We're specialists in dealing with disclosures. We've dealt with, in our time, hundreds and hundreds of disclosures. The firm's dealt with hundreds of disclosures as well, so we're very familiar with the process and with dealing with HMRC. We'll now take some questions from everybody. If you want to type them in the box, here's my contact details. If you need to contact me direct, it's d.jennings@churchill-tax-advisors.co.uk, and Philip is p.webb@churchill-tax-advisors.co.uk. We'll now turn to some Q&A, and I will just stop sharing my screen. Let's see what questions we've got. Someone's asking us if we can confirm about the time limits for assessing the 6, 12, and 20 years. That's fine. So those years, what it means is, as far as going back in time, what the revenue can recover, there is specific legislation that allows the revenue to assess certain tax years that have either not been disclosed, or obviously if you're voluntarily disclosing. The 4 years limit is where somebody has taken reasonable care and there has been no carelessness at all with their tax returns. So maybe if you've taken advice, you'd have to prove you've taken reasonable care. Maybe there's been a health issue and that's covered the relevant period as well. That's a possibility. Then if you've taken reasonable care and there's no carelessness, there's no deliberate, there's no fraud, the revenue will only go back 4 years to assess, or your disclosure should only cover the past 4 years. If, however, you're unable to prove that you've taken reasonable care, then you're either in a careless or a deliberate category. If you're in the careless category and it relates to a tax return that's been completed, then the revenue can go back 6 years, or your disclosure, your voluntary disclosure, excuse me, also should go back 6 years. If, however, the income relates to an offshore matter, There was new legislation that came in 2017, and providing the revenue could assess in 2018, they could go back 6 years at that point, which adds further time limits. And at the moment, the revenue have until April 2021. These are deadlines in the rules and regulations. They can go back to 2011-12 for offshore income under the requirement to correct procedure. Also, generally, the regulations around these time limits of 4-6 years were extended by a further 6 years for offshore income that's been undisclosed. That's going forward in the future, so it will allow the revenue to keep going back further and further as we go forward in time. If it's offshore income, that 12 years applies to carelessness. It doesn't have to be deliberate, but it does have to apply to offshore income. The 20-year rule applies where there's been fraud or negligence. In the old rules, pre-2008, it was called negligence. It's now deliberate behaviour, but obviously there's a crossover there with those particular years. 2008 is still within the 20 years. So if there's generally been fraud or behaviour, in effect tax evasion, the revenue can go back 20 years, or a disclosure needs to cover 20 years. Equally, if it's not actually to do with an incorrect return, but a failure to notify, there is a requirement to notify chargeable income within 6 months of the end of every single tax year. If you've never been asked to complete a tax return and have never completed a tax return, but you did have income you didn't disclose, you'll have a failure to notify that income. And the failure to notify rules are slightly different. And even if you've been careless, so you don't even have to be deliberate, the revenue can go back 20 years. Penalties are associated in similar sort of timescales as well. So that covers the ruling around 4 years, 6 years, 12 years, 20 years. So whether it's a WDF, whether it's a let property campaign, then either way, these rules cut across all types of income, all types of disclosures, and the disclosures should be made for the relevant number of years accordingly. Just seeing if we've got some further questions. Maybe one for Phil. Why should I make a voluntary disclosure? How will HMRC ever find out?
Well, I suppose that is a good question, because HMRC don't tend to do the VAT visits in the way that they used to in the past, where people used to get regular visits every 3 or 4 years and their books would be looked at. Now HMRC apply a more risk-based approach to visiting people based on their VAT registrations, certain trade classes, certain types of or certain amounts of tax that people pay. So yes, the chances are diminished, but the problem is that, as I mentioned during the my section, HMRC is still linked to Connect. So it may be that HMRC see from somebody's bank accounts that a large transaction has gone through for a certain amount of plant being bought and purchased from somebody else. They then may decide to cross-refer that to the seller's bank accounts as well, to see that it's gone through, and they may see that the money has entered their bank account, and then they may cross-check to the VAT returns for that period in which the transaction took place, and they see that the VAT returns show either a normal amount of VAT being, or VAT sales tax being declared, and nothing out of the ordinary because this large piece of plant has been sold. Then they send they want to do a compliance check, and you get caught. And the problem, of course, is that it won't be just the tax, it will be the penalty that will be associated with it. And your ability to reduce that penalty goes because they've prompted the inquiry. That's what the voluntary disclosure is there for, is for you to identify mistakes, identify something that's been missed, and basically it's for peace of mind. It will allow you to make sure that your tax affairs are in order, and it's a certain amount of protection from a penalty. I'm not saying there will be no penalty, although that could be an option depending on how the error arose, but it will be reduced if HMRC didn't come after you. I think better if you know a mistake or an error has been made to make the voluntary disclosure rather than not.
Yes, thank you, Phil. And it's sometimes with most income, it's not a question of if, it's a question of when.
Yeah, absolutely.
And we would obviously never advise anybody that they should, if they know they should be disclosing something, we could never advise anybody that they don't disclose. You know, we're a regulated firm, and I'm a member of the Chartered Institute of Taxation as well. So, you know, we couldn't condone any behaviour that didn't regularise tax if it's known to have not been disclosed. And equally, under the rules around promoters of tax avoidance, that could even catch somebody if you and money laundering rules. If you aid and abet somebody for not disclosing, for instance, then you could be facing risks yourself as an accountant. So it's best to take advice whether it should be disclosed or not, and how that disclosure should be made. We've had a question about ATED penalties, which is to do with if there's been no rental income. ATED is very similar to most returns. So if you've been late with the return, you'll be hit with a fixed penalty. If there's no tax to pay, yes, you could still end up with late penalties for failing to make those returns. There may be grounds for appealing those penalties. The revenues processes, they sometimes do make mistakes, so it could be a process failure with the penalty. We've seen that with self-assessment as well, and most tax returns. Equally, if you've got a reasonable excuse, and we've covered this before, if you've got a reasonable excuse, you've taken advice, the accountant or whatever has given you advice around the property and the company itself, then that might give a reason for appealing a penalty. We would say in most cases, you know, an appeal against many penalties is worthwhile making, unless you know that there's no grounds whatsoever to appeal a penalty. If you do need help on ATED penalties, then yes, please do get in touch with us. Me or one of my colleagues can certainly help you with that. Can I ignore a nudge letter if the money overseas has not been used by me or for me? I guess I'm not sure what you're asking there. Is this? I mean, if it's in your name, then obviously you should not ignore the nudge letter. If the revenue have issued a letter that relates to an account that's not in your name, you have to consider: do I have beneficial interest in that account? Do I have the right of that to that income? Or alternatively, are you holding that asset or that account on behalf of somebody else? Is it a bare trust? Are you holding it for somebody else's benefit and you've no right over that income whatsoever? You still may have reporting requirements. There may be a case or an argument that you don't have any tax liability. Obviously, this gets very complex. It becomes a legal matter potentially over ownership and entitlement to income or to assets, and you should certainly take professional advice. I think we've already covered, mentioned earlier on, that a nudge letter should never be ignored. It's only going to get worse. It's like most things. You get the brown envelope from the revenue, you put it back of the sofa, you forget about it. You get another one, you forget about that, and eventually you get a knock on the door. As we mentioned quite frequently, it's not a question of when. It's not a question of if, rather. It's a question of when. Almost got it the wrong way around there. So yes, whatever you do, don't ignore the letters. It doesn't necessarily mean there's going to be a liability. Take advice is what we'd always recommend. Let's see if we've got time for a couple of other questions. So I guess this is one where you've ended up being an accidental landlord. I moved in with my partner and let out my previous home. I wasn't making any profit on renting it, but should I declare that income? Do you want to go for that one, Phil?
Sorry, so can you repeat that? Sorry, it was breaking up.
Yes, sorry. It's an accidental landlord situation. So I moved out with my partner and let out my previous home. I wasn't making any profit from those rents, but should I declare that income?
Well, I think the answer here is that yes, all income should be declared. You should be on the tax return. If you've not made any profit, then you should be showing the expenses that are negating the profit. But yes, the profit should be declared. The rental should be declared on your tax return.
Yes, good answer. I mean, even if, I mean, one of the things, we come across this quite frequently, and I know it's been going around for a long time, but people forget that if you've got a mortgage, don't forget no capital payments can be counted as an expense. So if you're saying, well, I've made no profit on this property, why do I need to declare it? Well, don't forget that if you've been paying the mortgage against it, it's interest only that can be deducted against the rental income. And now that interest itself, if you're a higher rate or an extra rate taxpayer, and you only get relief at 20%. So in some circumstances, you could actually pay tax where you've no profit even on the interest. So even though interest is allowed and not capital, if you are a 40 or 45% taxpayer, it's possible that you've made no real profit on that property because you've been paying that interest, but because you only get interest relief at 20%, you could still end up paying tax. So if you're in that situation, please do get in touch, speak to your accountant, speak to us, we can help with making a disclosure. We no more questions are coming through at the moment, so that's been a very quick review of the campaigns. There are a number of items there that you need to be aware of. I think the crucial point we've almost hammered home today is when you get a letter from the revenue, get any correspondence from the revenue, if you get a nudge letter, an open inquiry, anything from HMRC, do not ignore it. Don't put it away and think, oh, it doesn't affect me, they've got it wrong, nothing to do with me, I've never had any income, it's not mine. Do take advice. If the revenue have got it wrong, we can pursue that point. If the revenue are not wrong and their suspicions are correct, you will face an investigation at some point in the future. It can be a few months before they open an investigation. It could be a year or two even afterwards. We've seen that before. Nudge letters have come out in 2019. The revenue have then opened an investigation in 2020. So yes, please, if there's one point to take away from today more than any other, don't ignore one of these behaviour, what's called nudge letter regarding let property or overseas income. Thank you very much. Please do join us in a month's time for the next tax investigation webinar session, and in 2 weeks join my colleagues Jamal and Hazel for the latest tips with regard to tax planning and tax advice generally. Thank you very much for joining us. Well, thank you very much for watching the video.
Thank you very much.
Goodbye.